Welcome back to Money Movers. Rising corporate defaults, at least the possibility of it, raising concerns around the stability of the credit markets. Fed cuts, of course, for the second time this year may help things. With us now to discuss the implications for the overall credit market is Oaktree Capital Management's head of liquid performing credit, co-portfolio manager David Rosenberg. I guess 25 basis points lower never hurts overall the overall credit market, right?
Certainly not a bad thing. I think the market, the real question is, does that mean we get another cut in December and another cut in January and so forth? And I think that Powell made it pretty clear that's not a guarantee. And so I think that's really going to be key to all of this. I think a lot of people have forgotten when tariffs got announced, there was a fear of the inflationary impact of that, even if one time. But a lot of people, when tariffs hit, they all went pre-bought inventory. Everybody stocked up, and so there was a lot of pre-tariff inventory, if you will, that needed to be worked through before you'd start to see an impact on prices. And most people said Q3 was when they were going to run out. And I think enough time passed, people frankly just forgot. And now we're in Q3, and everybody's remembering that, hey, now is the time where we might start seeing an impact. And so I think it's prudent to pause and see some more data before you decide what you're going to do.
Yeah, but where are we in credit spreads right now? Because they've been uniquely tight, I think, for some period of time, with occasional moments of opportunity.
And they're
perhaps
still tight. Yes, credit spreads are still tight, but I think, one of the many things our chairman, Howard Marks, makes a note of in his memos is that spreads are a measure of risk. And right now, if you look at the credit quality, you take the high yield market right now, it's the best quality high yield market we've seen in a decade. Highest percentage BB in over 10 years, lowest percentage CCC in over 10 years. And so while spreads are tight, I think they are reasonable relative to the risk you're taking today.
And so that's why you think that credit shines,
I do.
In part.
Well, I think there's two reasons, right? When you think about this market, I think you've got valuations in the equity market that are pricing in tremendous growth. So you need robust growth just for stocks to stay where they are, right? And I think we're in a period where things are likely going to slow down. I don't necessarily think we go into recession, but I think things slow down. Trump could wake up tomorrow and say, I didn't mean it, no tariffs. And things would still slow down because of all the demand destruction that happened due to all this uncertainty leading into the past few quarters. And so in a period where things are going to slow down, if you can have a contractual return in credit yielding 7 to 8%, you can lock that in. I do believe that shines relative to equities where the valuations require robust growth just to keep things from trading down.
What are some of the signs that you're seeing this return already? So we're seeing some signs that starting to return, particularly on the liquid side.
Yeah, when you look at the slowdown, when we look company by company, you start looking at consumer spending trends, and you look at especially the low-end consumer and their willingness and ability to keep spending money. And you see credit card delinquencies picking up, the minimum balance on credit card, the people paying only the minimum on their credit card hitting near record highs. There's data out there that makes you cautious about this continuing to go, trees growing to the sky and everything just going up forever.
It's been a long time since we had a recession.
It has been.
Yeah.
And
do you remember what happens to high yield bonds?
I was there. I've been doing this long enough to have been through it, and it wasn't fun. But I think right now, I believe we're heading into a credit pickers market. I don't necessarily think we go into deep recession because, frankly, we've been preparing for a recession for 3 years now. It's all people want to talk about: hard landing, soft landing, no landing. And so companies have been preparing. And so I think the core high yield credit, the core loan credit and below investment grade actually is in a pretty good spot with low leverage, good flexibility, good cushion and liquidity. But I do think if we do hit into recession or even just a slowdown, the ability to pick good credits is going to matter.
Right. All right. Well, we did have this brief moment where we were talking about First Brands and Tricolor for a few days, and then Jamie Dimon and his cockroach comments. Any real concerns on your part? Is that sort of did that present an opportunity as opposed to real risk?
It's always an opportunity, but I like to answer two ways, which is when people say, is First Brands a contagion? I say, well, there's fraud involved, and when you have fraud in a company, I don't think it's fair to assume there's fraud everywhere. And so I don't believe that is contagion. However, I do think it shows that underwriting standards are starting to slip. And people have raised a lot of money in credit, both public and private. And one of the many things I've learned from Howard Marks, when you raise a lot of money really fast, you buy what you can, not what you want to, because deploying that capital becomes a chore. And so I do think you're going to start seeing more and more things pop up where it's pretty clear maybe people didn't quite dig deep enough before they made that investment. And that's why I call this a credit pickers market.
Right. Hence the reason why people should invest with you.
Exactly. You said it. I agree.
Exactly. It's partially why you come on. Listen, David, appreciate it. Thank you.
Thank you for having me.
David Rosenberg.